What if the road to a $500,000 Bitcoin isn't paved by hype, but by debt, not having cycles, not ETF inflows, not celebrity tweets or speculative froth, but by stablecoins and the US Treasury market? Everyone's been distracted by Bitcoin's price action, meme coins, and political drama, but beneath that surface, a much quieter revolution is happening. The digitization of the dollar. In 2020, stablecoins were worth a few $billion today. They're pushing $180 billion and counting. USDC, USDT, and others are no longer crypto side projects. They're becoming global monetary infrastructure. And these digital dollars, they aren't held in cash, they're backed by US Treasury bills, government debt. So what's really happening here? Every new stablecoin minted equals more demand for US debt, and every new T-bill bought equals more yield flowing to stablecoin issuers and more trust in the system. But here's where it gets interesting. But where does this excess capital go? It can't sit idle, it has to move. Enter stablecoins, a bridge between fiat and crypto. A pressure valve for inflation. Jack Mallers, founder of Strike, doesn't see stablecoins as the endgame. To him, they're the prelude, the ramp, a necessary stage in the migration from fiat to Bitcoin. In his words, stablecoins are just a wrapper around treasuries. They help inflate demand for US debt, but Bitcoin is the final stop. The ultimate settlement layer. Fiat debases, capital flees to stablecoins, stablecoins buy treasuries. Yield gets harvested, but confidence in fiat keeps dropping. Eventually, capital seeks something permanent, scarce, neutral. That's Bitcoin. In Mahler's view, Bitcoin isn't fighting stablecoins, it's leveraging them. The bigger the stablecoin market gets, the larger the pipeline feeding into Bitcoin. Why? Because at the end of the fiat cycle, yield won't be enough. What people will want is freedom, ownership, hard money, and there's only one asset in the digital world with absolute scarcity: Bitcoin. 21 million forever. So what happens if Bitcoin hits $500,000? We're not talking about hype-driven growth, we're talking systemic adoption. $500,000 Bitcoin means Bitcoin's market cap surpasses $10 trillion. It's now competing with gold and sovereign bonds. Institutional demand explodes, not just for Bitcoin, but for on-ramp. Stablecoins become the default liquidity rail. To support a $500,000 Bitcoin, stablecoin supply needs to 5x or more, because the ecosystem around it needs to scale. Every on-ramp, off-ramp, collateral structure, exchange, and protocol starts to depend on stable liquidity. But remember, stablecoins are backed by debt. That means the US has to issue even more treasuries to meet the demand, which means the stablecoin industry becomes one of the largest buyers of US debt. Let that sink in. Crypto becomes the lifeline of the US Treasury market, and Bitcoin becomes the exit from it. Mahler's instinct isn't just about price targets. To him, this is a monetary inevitability. As fiat collapses under its own weight, as stablecoins absorb the capital trying to escape inflation, as the demand for real yield meets the limits of trust, Bitcoin stands at the end of the liquidity chain, not because it's the fastest, not because it yields interest, but because it doesn't lie. Fixed supply, self-custodied, neutral to every nation, yet valuable to every human. So maybe the path to $500,000 isn't just about charts. Maybe it's about architecture, about macro plumbing, about building the rails that eventually lead to Bitcoin. Governments want control, markets want yield, people want safety, and crypto, it's learning how to serve all three through stablecoins. But the twist: the more this happens, the closer we get to Bitcoin becoming the eye of the storm. Because when fiat fails, and treasuries falter, and even stablecoins show their dependence on the system, what's left standing is what never changed. Bitcoin, the sink that swallows all liquidity. The final chapter in a story that began with inflation and ends with digital independence. It's not hype, it's math, it's movement, it's time. Bitcoin, $500,000, isn't a fantasy, it's a signal. Don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the video. No announcement, no sudden shock, No viral tweet. Just a silent revolution, while the world watches wars, elections, and economic headlines. Bitcoin is quietly positioning itself as the foundation for the next era of global liquidity, not as a protest, not as speculation, but as infrastructure. The global monetary system is leaking. Central banks are trapped in cycles of rate hikes and stimulus. Currencies are losing purchasing power at record speeds. Debt is ballooning, and trust in traditional finance is cracking. We're not just witnessing inflation, we're witnessing a breakdown in trust. The world is hungry for a new foundation, something neutral, permissionless, and global. Fits the opening. Bitcoin has waited over a decade, for Bitcoin isn't here to replace the dollar, it's quietly becoming the bedrock behind the next version of Enter. Stablecoins look like dollars, they move like crypto, and under the hood, they're the fastest growing liquidity rails on Earth. Here's what most people miss. But as those stablecoins move faster and wider, especially in regions with weak currencies, users begin to ask a simple question: why stop here? Why trust a system backed by governments I don't believe in? And that question leads them inevitably to Bitcoin. Bitcoin doesn't need permission, it doesn't inflate, it doesn't care where you live. The more stablecoins circulate, the more Bitcoin becomes the final settlement layer beneath them, not by force, but by function. Jack Mallers, the outspoken CEO of Strike, has been ringing the bell early. In his view, the rise of stablecoins isn't a threat to Bitcoin, it's proof of its inevitability, because eventually, the rails that move dollars will move Bitcoin just as easily. In fact, they already do. Strike uses the Lightning Network to send dollars from the US to Africa or South America instantly by converting through Bitcoin as the bridge. Mallers believes this is just the beginning. If he's right, we're watching the next version of SWIFT and Visa, quietly forming on top of Bitcoin. In the West, Bitcoin still looks like a speculative asset. But in Argentina, Nigeria, Turkey, Lebanon, it's something else: a lifeboat, a remittance channel, a financial passport. Stablecoins are growing there faster than anywhere else, but with every leap in usage, something else grows in parallel: Bitcoin awareness. It starts with the dollar, but it ends with ownership, and Bitcoin is the only truly ownable digital asset. Bitcoin isn't trying to go viral anymore. It doesn't need to heil. Everyone is looking for the next meme coin pump. Bitcoin is being integrated into the plumbing of global finance. BlackRock sets government reserve. Central banks quietly watching. Fintech apps routing through Lightning. Stablecoins depending on Bitcoin for collateral, security, and mobility. It's not flashy, it's not loud, it's systemic. Bitcoin is slowly becoming the thing every other asset depends on, without realizing it. By the time most people recognize it, the wave will already be crashing over them. This isn't about price targets anymore. This is about function, about architecture, about inevitability. Bitcoin is evolving from an investment into infrastructure, from store of value into layer zero for global liquidity. It doesn't matter if Wall Street understands it, or if central banks approve, or if influencers promote it, because in the background, Bitcoin is being built into the foundation. Jack Mallers sees it. Developers across Africa, Latin America, and Southeast Asia live it, and soon, the world's financial system will depend on it, not because it's loud, but because it's the only thing that works when everything else breaks. This isn't a conspiracy theory. This is policy, playing out in real time, and the quiet part is now being said out loud. To $billion? That's how much the Trump media company just allocated to Bitcoin. And that's just the beginning, because behind the headlines, behind the memes, behind the political theater is a bigger plan. A plan that uses stablecoins to absorb inflation, Bitcoin to siphon value from fiat, and your retirement account as the on-ramp. Trump's media company just bought $2 billion in Bitcoin, not stocks, not real estate. Bitcoin, you don't do that for volatility. You don't do that to speculate. You do that because you believe Bitcoin is becoming strategic infrastructure. You do that because you expect the next wave of capital to be directed or pushed into Bitcoin, and you don't make that move without knowing what comes next. There's $3.5 trillion sitting in US government-managed retirement accounts, IRAs, for 101k. This is what economists call dead capital. It's passive. You'd unleash one of the largest asset migrations in financial history. And guess what? Trump just opened the US retirement market to crypto investments, not next year. Now, US debt to GDP is at 130%. That's unsustainable. There are two ways to fix it: slash spending and raise taxes, political suicide, or debase the dollar. That means print, inflate, let nominal GDP grow faster than the real economy, and reduce the real burden of debt. But here's the trick: you can't debase the dollar in a vacuum. You need something to debase it against. That's where gold and Bitcoin come in. If you're trying to quietly reset the monetary system, what do you need? You need everyone to own the things you're going to reprice the system against. Think of it this way: you let the dollar weaken Bitcoin and gold go vertical. System rebalances, the debt to GDP ratio improves. Without default or austerity, people feel richer because their 401k has just doubled. That's not just a macroeconomic fix, it's a political win. So how do you absorb the flood of liquidity that comes with dollar debasement? Stablecoins. They're fast, programmable dollars that move without banks. They're backed by US treasuries, and they're becoming the global dollar of choice, especially in the global south. But that's not all. Stablecoins aren't the end. They're the middleware, because what happens when trust in stablecoins wavers? When people say, "I don't want yield, I want freedom," they graduate to Bitcoin. Stablecoins funnel value into Bitcoin every single day. $3.5 trillion in retirement capital. New laws allow crypto exposure Americans buy into Bitcoin and gold via ETFs and asset managers. Stablecoins expand to handle new liquidity. Fat liquidity flows into US debt, creating artificial demand. Bitcoin becomes the foundation layer. This isn't just an investment strategy. It's a quiet liquidity coup. Jack Mallers said it best: stablecoins are the pressure valve. Bitcoin is the sink. So how do you absorb the flood of liquidity that comes with dollar debasement? Stablecoins. They're fast, programmable dollars that move without banks. They're backed by US treasuries, and they're becoming the global dollar of choice, especially in the global south. But that's not all. Stablecoins aren't the end. They're the middleware, because what happens when trust in stablecoins wavers? When people say, "I don't want yield, I want freedom," they graduate to Bitcoin. Stablecoins funnel value into Bitcoin every single day. $3.5 trillion in retirement capital. New laws allow crypto exposure Americans buy into Bitcoin and gold via ETFs and asset managers. Stablecoins expand to handle new liquidity. Fat liquidity flows into US debt, creating artificial demand. Bitcoin becomes the foundation layer. This isn't just an investment strategy. It's a quiet liquidity coup. Jack Mallers said it best: stablecoins are the pressure valve. Bitcoin is the sink.